Hi, we're talking about an option strategy called Iron Condor today. An Iron Condor is a combination of two option spreads. The first one is called a credit call spread, also known as bear call spread, and the second one is a credit put spread, also known as a bull put spread. We have done these in previous weeks, but so you could actually refer to the videos that I recorded for the bear call spread and the bull put spread in the previous weeks. However, with respect to the Iron Condor, what makes it unique is in order to set up a credit call spread, you need to set aside a collateral which is equal to the strike differences of your short call and the long call. And also, you need to set aside a collateral, a separate collateral, if you will, if you were to set them up separately for different stocks, for the strike difference of put spreads. However, with an Iron Condor, since you're setting the both spreads on the same stock, the collateral for the call spread will suffice for the collateral for the put spread. So this simply means that you have a chance to increase the return by double or more by setting up two spreads using the same collateral. So it is sometimes referred to as the holy grail of option trading, because you are maximizing the utility that you get from your collateral. However, it's an extremely risky strategy where you can earn a little commission for a whole lot of risk. But if it works, it's really nice. So what do you need for an Iron Condor? Well, you need a credit call spread, which includes a short call and a long call. And you need a credit put spread, a short put and a long put. So let's set it up and then let's see what can happen. I'm going to use Apple. Again, it's no particular reason, just because it's a nice lecture stock. So let's set it up first. We're talking about Apple Iron Condor. So we need the top side and we need the bottom side. So what I'll do first is I'm going to look at the price chart for Apple on TradingView. So this is, oh, I don't have Apple. So this is your Apple stock. Let's look at it on a daily price chart, and let's get rid of the charts that we had in the past. So what I'll do is simply, I'm going to draw a Fibonacci. I just wanted to see where the price volatility is. So I'll go from this high point to this low point, although that's an exaggerated low point, but it is what it is. So you see how at 61% Apple is at 283, and at 283 is acting like a good resistance point. So I'm thinking somewhere around maybe 300 if I could, and then maybe at around 270 if I could create a barrier for the Iron Condor. So let's get rid of this Fibonacci, and then let's put our wishful thinking just to see where we are. So I said somewhere around 300 would be nice, but I don't think, well, let's go with 295. It still scares me because the market is really volatile, but then again, we're using paper money, and this video is definitely not a financial advice, completely educational for paper money intention. So we're going to do a second one, and then let's go with 100, if we could, 165. Right, so let's go with that. Okay, so let's put it on, and keep in mind this is a vertical spread all over, so we're going to be using the same maturity date. So up we're talking about 295, and then down, you're talking about 265. So let's check out the option prices. Let's go with May 1st. That's next Friday. Today is April the 26th. And I'm going to go for the top first. So we said the 295 top. So we need a short call at 295. And then we need a long call. And then I want to see how much of a spread would be still profitable for us. So 295 is a, if you were to sell this, you sell that 228. 228. Now, if you go for a long call, say $1,000, that's a 305. Let's go with that. 305. Long call at 305. And if you were to buy this as insurance, that would be 80 cents. So overall, that is, we're getting 228, and then we are paying 80 cents. So that will be equal to 148 of a collection. Now, downside, and the reason that I went with 295 to 305, so if I were to do risk, that is 305 minus 295, and that is $10 per share. Since we get 100 shares, that is a risk of $1,000. But we're going to be collecting $128, so $148. So that will be our overall profit or potential profit. Let's look at the downside. On the puts, we said 265. So if you were to go 265, that's a bit low, but let's go with that. So 265 at 170. So we're going to have a short put at 265 at 170. Well, no, not even 162. And then we're going to have a long put as our insurance. Let's do $1,000 again. So if we go to 55, that is 62 cents. Huh? Convenient. At 62 cents. So the overall is that we get 162, and then we pay 62 cents, right? Yeah. Which means that we end up getting a positive 1. Since we have 100 shares, we will get $100. And the risk is, again, 265 minus 255. That is $10 a share. We have 100 shares, and that's going to be $1,000. Now, notice that our risk is the same. It's $1,000. If we were to set it up so that one side has a risk of $1,500 and the other side has a risk of $1,000, the collateral for the iron condor would be higher of the two. So, usually what I try to do when I do trade is that I try to keep them balanced, but not necessarily. So this is how you would set it up. So let's look at potential outcomes. So we have, notice we have 4 positions. We have the short call, the long call. We have short put, the long put. So let's take a look. So the position, a specific position, strike, and then price, cost, maturity, and then we'll talk. So position is, first one is a short call. You're going to have a short call, and we're going to have it at a strike of 295, and let's have everything in the middle. Price was 228, and then the cost was this times 100, and maturity was May the 1st. Then we have a long call at 305, and this was a cost of 80 cents. And then overall the cost is $80, maturity is the same. Now we have a short put. Strike price is at 265. We get 162, and then the cost is 162 times 100. Maturity is the same. Then we have a long put, that's our insurance for the downside, at 255, and it was 62 cents. The cost is 62, and then the maturity is the same. Now, what I want to do is, now that we're talking about 4 separate positions, I want to point out which ones I'm actually buying and which ones I'm selling. So I'm going to leave the short call and the short put as they are, but the long ones, I'm going to put a little negative sign in front of it, and then just to point out that these are the ones that I'm actually paying. So the overall is the total of these, and we basically get a $248 out of this iron condor setup. Now the risk on the upside, so risk for calls and then risk for puts, right, is the 305 minus 295, that is $10, and then we multiply that by 100. That's your exact risk. Okay, so then we're going to do the puts. We have 265 minus 255 times 100, and that's also $1,000. Now the overall risk, right, for the iron condor is the maximum of these two, so it's $1,000. But if you were to set it up unbalanced, asymmetrical, then, well, unbalanced, then the overall risk would be the higher of the two. Now let's say that we talk about scenarios, right? So let's say we were with a scenario number 1 where the actual price goes up to 320. Right, so your spot price goes up to 320. This is for Apple. So your short call is going to hurt, because it's going to cost you 320 minus the 295, because that's your short call. Actually, let's do it the other way around. 295 minus the 320, that's and then times 100. That's a $2,500 loss. Now, with respect to the long call, well, now it's 320 minus 305 times 100, and that's a $1,500 profit. Notice I could make this 400. So if we were to, look at the overall cost, right, it would be this plus this, $1,000. I mean, the spot price can go up to $1,000, and that, that $1,000 loss wouldn't change, simply because you have a short call and a long call as your insurance. So if we go for 350, that is what it is. Now, the same thing with the short put. With the short put, well, your short put is actually worthless, because the spot price went up to 350, so it's 0, and long put is also worthless because it went up to 350. So you see why the overall risk has to be the maximum of the two, because the price can end up only in one spot. It's either up or down or wherever it's going to be. It's going to be, you cannot lose on both of them it after the maturity date, simply because um, the price can end up only on one direction. So that's if the spot price goes to 350. Now, what if the spot price goes to 200? That's your scenario number 2. Now, your short call is worthless because price went down to 200. And then your long call is worthless because price went down to 200. Now, your short put, ooh, that's going to hurt. So 200 minus 265 times 100 is your overall loss. So you lost 6,500. Now, on the long put, that is 255 minus the 200 times 100, and that's your profit. So looking at them both, your overall is the total of the two, so you lost $1,000. And that was your overall risk for the calls and overall risk for the puts anyhow. So notice the price went up to 350, went up to 200, and these are two extremes. When the if you look at the chart, the basically price has actually breached above our top line and below our bottom line. So since we are expecting a good scenario where volatility is not, we're expecting a low volatility in price, let's look at what if the price is around 290. So if the price is 290, our third scenario, on the maturity date, your call will be worthless and your short call will be worthless because the spot price is 290 and you have your counterpart has a right to buy at 295. They would never buy from you because the price is 290. The long call is 305. That's the one that you got, and that's worthless. Now, the same thing with the short put. They're all worthless, and that's what you're counting on anyways, because this is a credit spread on both sides, and therefore what happens is you get to keep your initial premium. That's what we're playing on anyways. You are expecting to keep that $248 by risking $1,000. If this happens and Apple stays at around 290 or between 295 and 265, within that $30 range, and closes the week out on May 1st within that price range, you get to keep your $248. And against this $248, you're risking $1,000. Now, that's a return of about 25% on $1,000 collateral, but it is a very high risk, especially nowadays when the VIX is so high, and that is why this strategy is actually paying this much. Just to give you a basic idea, think of it like this. If you're making 25% a week, you realize how outrageous this return is. And there is no free lunch. And therefore, you have to realize what an outrageous risk you're taking. So the likelihood of you losing that $1,000 is so high that the return that you're getting is 25%, approximately 25%. So this is a very high risk and a high return strategy.